In the world of business, when is just as important as how much. Imagine you bake a cake for a neighbor today, but they don't pay you until next month. In which month did you actually earn that money? The answer depends entirely on which side of the accounting fence you stand on, cash or accrual. These aren't just different ways to keep books, they are different ways of viewing reality. Today, we're breaking down the mechanics, the scripts, and the visual flow of these two fundamental accounting methods. Cash basis accounting, the in-your-pocket method. Cash accounting is the most straightforward method. It's exactly how most people manage their personal wallets. You record revenue only when you receive the cash, and you record expenses only when you actually pay the bill. The script for cash accounting. Step 1, did I get paid today? Yes, record revenue. Step 2, did I pay a bill today? No, do nothing. In this scenario, your financial statements for January would show you did zero work, while February would show you were a superstar. It's simple, but it doesn't always reflect the effort of the business in real time. Accrual accounting, the promise and performance method. Accrual accounting is the standard for larger businesses and public companies. It follows the matching principle. Revenue is recorded when it is earned, the job is done, and expenses are recorded when they are incurred, the resource is used, regardless of when the cash moves. The script for accrual accounting. Step 1, did I provide the service or ship the product? Yes, record revenue, accounts receivable. Step 2, did I use electricity this month? Yes, record expense, accounts payable, even if the bill isn't due until next month.
This provides a much more accurate picture of a company's long-term health. It shows the economic reality of the business's activities during a specific period. Let's look at a side-by-side of a consulting firm in December. They finished $10,000 of work, unpaid, and paid $2,000 for rent. Look at that massive difference. Under cash basis, the company looks like it's failing. Under accrual basis, it's clearly profitable. This is why investors prefer accrual. It shows the potential for future cash. Accrual accounting relies on two bridge accounts to keep track of the time gap. The visual flow. The sale. You ship a product, you debit accounts receivable and credit revenue. The collection. 2 weeks later, the customer pays. You debit cash and credit accounts receivable to clear the bridge. Without these bridges, the accrual method wouldn't work. They act as placeholders for the cash to be received or cash to be paid. So why doesn't everyone just use accrual if it's more accurate? Cash basis is for simplicity. It's perfect for sole proprietors or small businesses with no inventory. It tells you exactly how much money is in the bank to pay your bills today. Accrual basis is for complexity. It is required by GAAP, generally accepted accounting principles. It is necessary if you have inventory, employees, or if you need to apply for a significant business loan. The danger of cash basis. It can hide upcoming debt storms. You might think you have $5,000 in the bank, but if you have $6,000 in unpaid bills sitting on your desk, cash basis won't show you that you're technically underwater. Taxes are often a deciding factor. Under cash basis, you can sometimes lower your tax bill by delaying the cashing of a check until January 1st, or by paying your January rent on December 31st to increase your expenses for the current year. However, the International Reporting Standards, or IRS, has strict rules. Once your business reaches a certain size in revenue, you must switch to accrual. It's the law's way of ensuring you aren't manipulating your cash to hide profits. Neither method is wrong. Cash basis is a snapshot of your current liquidity, your survival. Accrual basis is a panoramic view of your business's value, your success. The best business owners understand both. They use accrual to see if they are making money, and they use cash flow statements to see if they can pay their employees on Friday.